Regular people with ordinary jobs have quietly built extraordinary wealth in the stock market. Not through perfect timing, not through brilliant predictions. They built that wealth by staying invested long enough for compounding to work. And that process includes something most investors fear: market crashes. Because crashes feel like financial disasters in the moment. But historically, they have also been some of the most powerful moments for long-term investors. To understand why, we need to look at how markets actually behave over time. Market declines are normal. When people imagine the stock market, they often picture a smooth upward line. In reality, the path looks very different. The market declines roughly 10% almost every year. Larger corrections of 20 to 30% appear every few years. And deep bear markets, where stocks lose 40 or 50% of their value, tend to happen about once every decade. Each crash arrives with a different explanation. Sometimes it is a financial bubble. Sometimes a banking crisis. Sometimes a global shock that no one expected. But despite the different causes, the pattern has remained remarkably consistent. Markets fall, investors panic, and eventually, the market recovers. The difficult part is that the recovery always feels impossible while the crash is happening. There is a powerful psychological reason market declines feel so dangerous. Human beings experience losses far more intensely than gains. Behavioral economists call this loss aversion. Losing money hurts roughly twice as much as gaining the same amount feels good. That psychological bias turns temporary market declines into emotional events. Imagine a portfolio worth $10,000. During a market correction, it falls to $7,000. $3,000 disappears. Even if the decline is temporary, the emotional response is immediate. The instinct is to act, sell, move to cash, protect what remains. But history repeatedly shows that reacting emotionally during market declines can become the most expensive decision an investor makes. One of the most fascinating patterns in market history involves the best days in the stock market. Research examining the S&P 500 between 1980 and 2022 shows something surprising. Investors who remained fully invested during that entire period earned roughly 11% annual returns. But removing just a handful of the market's strongest days dramatically changed the outcome. Missing only the 10 best days cut total long-term returns nearly in half. And those best days rarely occurred during calm, predictable markets. They often happen during periods of intense volatility, sometimes immediately after major declines. This creates a difficult paradox. The exact moments when investors feel most compelled to sell are often the moments when staying invested matters the most. Consider the early 2000s. After years of rapid growth during the technology boom, the market entered a severe downturn. The S&P 500 lost roughly half its value over the following 2 years. An investor who had $10,000 invested at the peak would have watched that portfolio fall to roughly $5,000. At the time, the decline felt catastrophic. But markets move in cycles. Over the following years, the market recovered, and long-term investors eventually saw their portfolios grow far beyond their original value. A similar pattern appeared during the global financial crisis. Between 2007 and 2009, the stock market again fell by more than 50%. An investment of $10,000 temporarily dropped to less than $5,000. The headlines at the time predicted economic collapse. Yet the recovery that followed eventually pushed markets to new highs. Even the dramatic crash during the pandemic followed the same pattern. In early 2020, global markets plunged more than 30% in just a few weeks. Fear dominated the news cycle. But within months, the market had recovered, and the long-term upward trend continued. Each crisis felt different in the moment, yet the long-term pattern remained remarkably consistent. Decline, recovery, growth. Investors who understand this historical pattern approach market declines very differently. Instead of fearing them, they prepare for them. Warren Buffett has often held large reserves of cash inside Berkshire Hathaway. Not because he expects markets to crash constantly, but because downturns occasionally create rare opportunities. When markets fall, strong companies can suddenly be purchased at lower prices. The same event that frightens many investors becomes an opportunity for disciplined ones. Buffett summarized this mindset in a single phrase: be fearful when others are greedy, and greedy when others are fearful. One of the most effective ways investors manage market volatility is through a strategy called dollar-cost averaging. Instead of trying to predict the perfect moment to invest, money is invested consistently over time. Monthly contributions continue regardless of whether markets are rising or falling. When prices are high, those contributions buy fewer shares. When markets decline, the same contributions purchase more. Over long periods, this approach removes much of the emotion from investing. Market declines stop feeling like disasters. They begin to look more like temporary discounts. Another key defense against market volatility is diversification. Market crashes rarely affect every sector equally. The technology bubble of the early 2000s provides a powerful example. Technology stocks lost more than 70% of their value during that collapse. Investors who concentrated heavily in that single sector experienced devastating losses. Diversified portfolios, spread across industries and asset classes, proved far more resilient. Diversification cannot eliminate market risk entirely, but it can prevent a single collapse from destroying a long-term investment strategy. When viewed over decades rather than months, market crashes appear very different. They look less like permanent disasters and more like temporary interruptions in a much longer upward trend. Compounding continues working quietly through all of it. Markets fall, markets recover, and over time, they continue to grow. For disciplined investors, the greatest risk is rarely the crash itself. It is abandoning the strategy during the crash. A simple thought experiment: consider an investor who began building a portfolio around the year 2000. Their journey immediately included multiple crises: a technology bubble bursting, a global financial collapse, a pandemic that shut down the world economy. Each event triggered fear across financial markets. Each event caused sharp declines in portfolio values. And each event convinced many investors that something fundamentally different was happening this time. But imagine that this investor simply stayed invested through all of it. No panic selling. No attempts to predict the perfect moment to exit or re-enter the market. Just patience. Over time, despite multiple crashes and periods of uncertainty, the long-term trajectory of the market continued upward. What looked like devastating losses in the moment eventually became temporary declines within a much larger growth trend. Market crashes will happen again. They always do. New headlines will predict economic catastrophe. Markets will fall sharply, and many investors will feel the same instinct to abandon their strategy. But the long history of financial markets suggests something important. Crashes are not the opposite of long-term investing. They are part of it. The investors who ultimately build meaningful wealth are rarely the ones who perfectly predict the future. More often, they are the ones who remain disciplined when uncertainty appears. They accept that volatility is the price of long-term growth, and they give compounding the time it needs to work. The difference between investors who build wealth and those who abandon the journey is rarely intelligence. It is patience. And patience, in investing, has historically been one of the most valuable assets a person can own. Thanks for watching.